Welcome to Kopi Time, a podcast series on markets and economies from DBS Group Research. I'm Taimur Baig, Chief Economist, welcoming you to our 104th episode. Today, it's all about China. While in the US, you have this whole story of resilient economic growth and still sticky inflation, which has combined to create this narrative of interest rates going higher for longer. The opposite is the case in China. Post-pandemic rebound has been underwhelming. Financial markets are listless, and growth and inflation momentum is muted. What to make of China's near and medium-term outlook in the context of all that? Well, we have a seasoned expert with us to talk about all this. Santiago Millán is a member of Wellington Management's Global Macro Strategy Group. Wellington is one of the world's largest asset managers with over $1 trillion of client assets under management. Santiago leads their efforts in thematic analysis and sector-based macro research for China and other Asian countries. He's an active participant in investment strategy groups focusing on both debt and equity markets. Santiago Millán, welcome to Kopi Time.
Thank you. It's my pleasure to be here.
So good to talk to you, Santiago. You and I met almost 15 years ago, and we have met in multiple places in Asia. I was just thinking, I think we were on a trip to Philippines once. I met you in Hong Kong many times. Great to have you on the podcast.
Thank you. Yeah, no, it's great to see you. And it's been quite an adventure over the years.
Indeed. You are talking to me from Boston, but that has not been your address the past decade and a half. So reflect on what you have been doing the past decade and a half.
Sure. So, well, it's been definitely an interesting decade. I would say that I've been observing from almost a front row seat all of these changes and development that has been happening in China and in Asia more broadly. And China has changed a lot in 15 years. When I arrived in Hong Kong, China was at the tail end of a spectacular boom in the economy that had begun with China's accession to the WTO and lots of reform and opening. The economy was booming, asset prices were booming, everything. The stock market had more than tripled in 3 years. And the world's leaders all came to Beijing for the 2008 Olympics. The vibe was one of pervasive optimism, and this carried through even through some of the doubts of the global financial crisis. And indeed, China did do a lot of the heavy lifting to get the world out of the GFC. The economy actually did deliver since then. When I arrived in Hong Kong, China's GDP was $3.5 trillion. It was the fourth or fifth largest economy in the world. Since then, China's GDP has grown fivefold. It's now $17 trillion plus. And China was supposed to grow a lot. It did grow a lot. However, not everything was as expected. In particular, one would expect with this type of performance that I just described, that, well, asset prices would have done fantastic. And guess what? They didn't. In part for structural reasons, but also because of this fact that I mentioned, which was that the asset prices were in a huge bubble in 2007, early 2008. The stock market in those 15 years has actually been flat or slightly up or down, depending on how you measure it. HSCEI, which is the index of China mainland listed companies in Hong Kong, is actually down almost 40% from the day I arrived in Hong Kong to the day I left in Hong Kong. So economy grew by 5 times. Stock market did nothing. Qualitative changes, however, have been huge. And I think they're even bigger than the quantitative changes. What are these qualitative changes? Well, first, the infrastructure stock has flourished in an unbelievable way. When I got to Hong Kong, the first high-speed rail line was just being inaugurated from Beijing to Tianjin. I remember I wrote it, and it was really exciting. Now, the country has by far the largest high-speed rail network in the world. 50 or so Chinese cities have subway systems, and this connectivity infrastructure is massive, and it has all been developed in the last 15 years. Education has also changed dramatically. When I got to Hong Kong, there were around 2 million graduates from higher education every year. This year, it will be 11 million. And finally, I'll mention one thing among many others that have changed dramatically: the development of the service economy. And I remember when I got to Hong Kong and started having discussions about what was a future of the Chinese economy, there were many, many doubts about whether China would or could develop a really serious and successful service economy. And indeed, it has. It's already there. There are challenges, and we can talk about them, but those are my observations in the rear view mirror. Time to look forward.
Indeed. Santiago, I do want to talk about some of the structural challenges with you in the latter part of this podcast, but let's stay with the near term for the time being. So what's your sense of China macro at this point? So economic momentum for the second half of this year, underwhelming, worrisome? Where do you stand?
Yeah, absolutely. I think that it's very difficult to really calibrate a message that targets an audience accurately. And the reason is that the spectrum of beliefs about the Chinese economy is very, very wide. But I agree with, I think, what you suggested, which is that there is a lot of pervasive pessimism. I think that pessimism has a grain of truth, but I wouldn't really go overboard with a narrative that suggests that China will collapse or that China will face a Japan-like scenario in the future, most importantly because China is still not a developed economy. But one thing to keep in mind is that the policy and institutional objectives of the Chinese government have changed significantly. And this goes to a burning question and a source of frustration, I would say, for the analyst community and the investment community and some of the business community, which is, why aren't the policymakers as worried as we are? We read headlines about youth unemployment rate above 20%. We see the economic activity indicators come in worse than expected month after month. What's going on? Why aren't they worried? And I think there are two answers there. The first one is that the authorities actually, frankly, don't see the type of negativity that the markets see. They are very focused on the medium term, and in the medium term, they feel that that there needs to be a lot of patience, and they are uncomfortable with the type of breakneck infrastructure-driven growth that was there in the past. The one that I mentioned, for example, that allowed China to do a lot of the heavy lifting for the world to get out of the global financial crisis. And and I know that you wanted to stick to the short term, but I'll mention one long-term issue because I think it is very relevant to the short term, and that is that I think China is right now in the process of shifting or making its third big shift or big change in the policy stance, in the institutional priorities of the government and of development. And what is the third? Well, the first one was essentially the revolution itself, the establishment of communism from the revolution in 1949 all the way until reform and opening. All of the economic activity in China was politically determined. That led China to a situation in the 70s where its GDP per capita was lower than sub-Saharan Africa. Its industrial share of the economy was lower than North Korea. And it was very clear that the some of the development objectives of the policymakers were not going to be met. And this led to the second big period of or institutional framework, which was reform and opening. And we know what that was all about. It was about letting market forces enter the economy and unleash massive amounts of economic activity. It worked very well in achieving development itself and growth itself. But around 10 years ago, again, China found itself with a bunch of externalities to that model that its policymakers didn't particularly like. And what are those externalities? They are massive environmental damage. They are big inequality. By some measures, Chinese income inequality and also wealth inequality are even bigger than the United States. And also, one other externality was that the open markets and access to these types of opportunities created pockets of wealth that combined with pockets of power that created a degree of political uncomfortableness that the leadership was not happy with. And so now we are in the third big era of institutions, policy making, and governance. And let's call it the era of common prosperity, for lack of a better word. And we don't really know what this era really means. Just like in the beginning of reform and opening, we didn't know what it would be like. Right now, we are crossing the river by feeling the stones, if you will, trying to determine what the new era of common prosperity means. But one thing we know for sure, the emphasis on growth at any cost and the emphasis on material advancement is not there. And that answers a lot of this frustrating question: why aren't the policymakers as worried as the market?
Fascinating characterization, Santiago. But I would assume that lack of clarity runs beyond the analyst community and spills over into the day-to-day Chinese population. And would you say that frustration or lack of clarity as to where things are going is one of the reasons why we haven't seen a big post-pandemic bump? Because that uncertainty clouds people's animal spirits and exuberance, and therefore, yeah, I can go out now, but I don't think I'm going to spend a lot of money or plan for a major, expansion of my company.
Absolutely, I think that's very much right. Obviously, the whole picture is a mosaic that is complex and includes more than just this. But this ingredient, I think, is very, very important. You see that on this area, the government is not exactly standing still. Yes, there are changes, and those changes create uncertainty. But you do see parts of the leadership, for example, the Premier Li Qiang, frequently approaching the private sector and other constituents in the economy, trying to reassure them that the role of the private sector will still be almost the core of the Chinese development, producing the bulk of the employment, producing the bulk of the consumption, and therefore the bulk of the momentum for the Chinese economy. With that said, back to your point on the issue of confidence, it's important to remember that the 3 years of COVID and geopolitical conflict and also political transition were quite traumatic for the Chinese consumer and business environment, much more so, I would say, than for the rest of the world. This is not just about the lockdowns. This is also about some of these signals about changes in institutions. I would say one big one that the markets, of course, were very much affected by was the regulation of the I would say, of certain areas of private services, including platform internet companies, and of course, the private education sector. And those two things, among others, got people very, very nervous about the overall direction of the Chinese economy. And now we are, again, I would say, in this process of discovery of what the true environment is like. My assessment of this is that the true environment is definitely not as it was in the era of reform and opening. So it certainly is different, but it probably is not as negative as some of the more negative narratives that there are out there, and probably not as negative, or very likely not as negative, as what some of the more depressed areas of the Chinese stock market are suggesting. In particular, I would point to these Hong Kong listed Chinese stocks that are owned mostly by international investors, which are trading at some of the lowest valuations, depending on how you measure it, in 20 years, sometimes more than 20 years.
Right. So what does that mean for the financial markets in the near term? Is a valuation attractive because it's low, or the valuation is not attractive because the low valuation is telling us something?
You had to ask a difficult question, didn't you? Yeah, I think. Well, the first thing I would say is that if you look at equities, there is a very, very big segmentation in the market, offshore and onshore. My view is that the offshore equities are simply too cheap, even if we factor in the fact that the developments are actually concerning. I frequently describe the valuation for these stocks as the inverse of a bubble. Why is that a useful concept? Well, a bubble on the upside typically forms because the market recognizes a fundamentally structurally positive aspect of a market or an industry. The internet today, what we're doing today, actually right now in this conversation, is probably 20 times better than what anyone imagined in the year 2000, and yet it was time to sell stocks. Back to the China example, I think the market did recognize that there are some reasons for concern. As I said, this is a big change in institutions. This is a big change in the policy stance. Lots of uncertainty is involved. But the way that these stocks are trading at single-digit trend PEs and valuations that are lower than they have been in multiple decades suggests to me that this is overdone and that there is upside in the offshore stocks. The onshore stocks are much more complicated. On the surface, they look, in my view, basically fairly valued. But the problem is that once you open up the hood and you see, you have a look at the stocks that investors actually like, that bottom-up analysts find quality in, you find that lots of these stocks are actually, again, in a segmented market, trading at very, very high valuations. And so it is a very difficult job to be a China stock picker.
Right. I mean, like just this year, we've seen China bank stocks and telecom stocks rally, something that they haven't done in a very long time. And the darlings of recent years, the tech stocks in particular, have done absolutely nothing onshore or offshore. Santiago, earlier you were talking about authorities have begun to make overtures to market participants, saying that, the tumult of recent years, it's behind us. Things are going to be constructive. Private sector has an important role. So go out, innovate, invest. We're behind you. So let's talk about the whole regulatory backlash of the last couple of years. And is it indeed your sense that we're at an inflection point, that there are not going to be as much backlash going forward? I sort of think you sort of touched upon the services sector, particularly education, tech. For me, gaming, crypto, other things come to mind, and of course, general data privacy issue around which some tech companies have been really hurt by the regulatory I was going to say overreach, but rather regulatory action. So where are we with respect to the whole regulatory framework?
Yeah, no, that's a great question. My view, as typical, is that it's a mixed bag. I would say that the place I would start is that the regulation of these sectors was inevitable, and it's not just inevitable in China; it's inevitable pretty much everywhere else in the world. A lot of the regulatory steps that really got the market spooked were very similar types of data regulation and anti-monopoly regulation that, for example, Europe has. Now, with that said, the elephant in the room is that Europe has no world-class internet companies, and it is probably no coincidence that they have strong regulation and no world-class internet companies. The strong regulation in China, I think, is unlikely to eliminate the internet companies altogether, as it did in Europe, or the big ones at least, because China is essentially a protected market, and it is very difficult for foreigners to compete in that market because of the obvious reasons. But nevertheless, it's important to realize that these regulations are there, and they're not going to go away. With that said, within the birdcage, if you will, of these regulations, there is no reason why these companies cannot continue to grow and to grow a lot. It's going to be a more competitive landscape than it is in other places. Valuations definitely need to adjust for this new reality, but they have already adjusted. And the last thing that I would say is that the government seems to be kind of two minds about the service sector and service-driven GDP growth. On the one hand, lots of the leadership recognizes that the service sector is essentially the engine of job creation in China. In fact, manufacturing employment in China peaked around a decade ago, has been coming down ever since. Manufacturing output continues to rise because of automation and other things. This role as an employment creator is very important and valued by the leadership, and they are very unlikely, I would say, to kill this goose that lays golden eggs in that sense. And the last thing that I would say is that there's also a recognition by the leadership that the service sector, and I would say this interconnected digital service sector, the world of platform economies and so on, virtual worlds, is very, very important to essentially do something very basic but critical for economic development, which is to enlarge the market. The market is much, much bigger when there is so much connectivity, when each individual supplier has access to not just a handful of customers around their neighborhood, but to a huge national market. And therefore, the service sector in general and digital interconnected services in particular are something that is unlikely to be crushed by the government. The heavy lifting of the regulation, in my view, is already done.
So speaking of digital services, this year is all about large language models and AI. We have seen amazing run-up in a select group of stocks in the US around that narrative. Seem to be missing that in the context of China, although like if I follow South China Morning Post, there are stories that are coming out about how companies from Alibaba to Baidu are sort of bringing in various layers of AI capability. The authorities are engaging the private sector and setting up some degree of thinking and uniform standards about AI. But somehow or the other, it's not really catching the global investors' interest.
Yeah, I think that's interesting. I mean, to your point, there are places where it is catching interest, and in particular in the A shares. When you look at certain companies that are geared towards this, some of which you mentioned, they have performed quite well. But I definitely agree that overall there isn't that sense of hype. Um, I would say that a lack of hype does not mean that there is an absence of the AI development in China. I think it's important to remember that the IP for AI is very much well. China is a very, very important player in generating the IP. If you look at, for example, the proportion of cited peer-reviewed papers in the top 1%, China is, I think, number one or close to number one. And if you look at, as you said, the development of the AI, there are multiple companies that are doing this. One thing to keep in mind is that China, as it was with other digital services, is going to take a much more conservative attitude towards the regulation of this. And perhaps a lot of what is keeping the overall participants and the investors from reaching a stage of euphoria is the uncertainty about what that regulation means. I understand that. And as you might guess, my opinion lands somewhere in the middle. Mm-hmm. I don't think that a hype around AI in China is merited because there is uncertainty. But I also hear a lot of pessimism that China will fall far behind the rest of the world in AI because of some of these issues, and also because of the geopolitical issues having to do with semiconductors. And my view is that in the medium term, China will continue to be at the forefront of these developments, and we will see huge amounts of applications of AI. One last thing is that AI in China is also much more present than in other parts of the world in things like city management, smart cities, and this is probably under-recognized how much efficiency gains there are from this, in particular in a world that tends to look at these headlines through the darker side of the narrative, which relates to control of the population and so on.
Santiago, not now, but rather 6 years ago, I was using ride-hailing apps in Shanghai, and they had simultaneous translation. And I was sort of, reading about the way the supply of ride-hailing cars were managed through their AI framework, calibrating toward, rush hour versus not. I mean, these things, they've been old hats at it for a while. So yeah, I fully agree with you that the layers of application, it's not like something that began or ending with ChatGPT. They've been at it for a while.
Yeah, that's right. Image recognition is a huge part of AI, and China was there from the beginning. Their companies and their institutes were, at the forefront of the competitions in image recognition, for example, which was one of the first big steps in the development of AI. And now I'll give you an example of something that I saw recently in China, which was a service that allows for companies that do the maintenance and the checking of power lines to do this without people. It used to be that you had to have armies of thousands of people that would physically climb each utility pole and check to make sure everything is all right. Now, with computer vision and image recognition and artificial intelligence, this is done in a period of 3 days using 3 people that manage drones remotely, whereas it used to take thousands of people more than a month to do it in the past. So these are the types of things that can happen with the development of AI.
Santiago, earlier at the very beginning of this conversation, when we were talking about you coming to Hong Kong 15 years ago, and you mentioned that China played a very important countercyclical role at that time with very large stimulus measures, just as the world economy was struggling under the global financial crisis. But of course, the legacy of that big stimulus was the mother of all debt formation, and that trend has just kind of progressively gotten worse over the past decade and a half. So let's talk a little bit about China's debt overhang. Looking at other countries, you used to work on Latin American countries, you've looked at other examples around the EM and DM space. What are the lessons from other countries with debt management that China can sort of embrace to deal with this debilitating problem?
Yeah, no, that's a very good question, and also begs the question, is China different because of its size, because of its policy? I would say there are 2 big lessons from other countries. The first one is don't rely on the kindness of strangers to fund your financing gaps, and the second one is to ensure that you can coordinate the players that are engaged in the distribution of the debt if it has to be restructured. China has those 2 factors. Its debt is owned almost entirely domestically, very, very little exposure to foreign funding, and China is an excess saver rather than an importer of savings, and that could be problematic in other areas, but it's definitely not a problematic when we think about it in terms of the debt angle. I would say, maybe I'll finish here. China definitely does have these factors that are lessons learned from other places, but that doesn't mean that the debt isn't a problem.
Right. So I normally, this is my old IMF training that, the debt dynamic equation, which is a function of, your real interest rate and real GDP growth rate. If you, through financial repression, for example, keep interest rates very, very low, so it sort of turns negative in real terms, you can afford a lot of debt. And I think China, by virtue of having somewhat of a closed capital account, can have monetary policy that is, attuned toward financial repression while the rest of the world is struggling with high interest rates and high inflation. But the bad thing out of all that is, of course, you then end up having zombie companies a la Japan, or you stay with the slow burn as opposed to, recognizing issues quickly. Clearly, the authorities don't have an appetite to remove the Band-Aid, right? It would be a slow burn.
Yes, I would say that the general answer to your question is yes. One thing though about the near term and actually the present, is that there is a recognition that perhaps given some of the factors that you are talking about, which is a relatively stable environment that is facilitated by financial repression, that there could be steps taken to tackle at least the local government and LGFB, local government financial vehicle, and provincial debt situation. That is a possibility in the near term. It will be complex and full of uncertainty because the government needs to take action while reducing the risk of moral hazard. It needs to restructure things and promise that they will never be restructured again. This will not be a quick or simple process. It probably begins with a centralized audit of all of the provinces and all of the debt, and to figure out how to match the liabilities with assets, to figure out what is the solvency of these provinces. And they probably know that already, but the reason why an audit would be necessary in the beginning is to make it all common information so that everybody knows how everybody else is doing. From there, figure out what a portion of the debt problem can be resolved by simply matching assets with liabilities and selling assets to free up cash flows and so on. And then, after that, having the more difficult steps of actually restructuring some of these debts and figuring out where the financing is going to be, where the funding is going to be to do this. Despite that, however, I would say that the big picture remains that Chinese growth, and this is somewhat unique to China, but there are a lot of Asian countries that share this feature, is very much debt-driven. And those issues that you mentioned are very real, not just zombie companies that essentially live beyond their useful purpose, but also from an equity investor perspective, it's very important to remember that over the medium term, excessive reliance on debt will eat into the cash flows to equity. And that, I think, is one of the reasons for this lackluster long-term economic market performance that I discussed earlier.
Very, very interesting. Let's talk a little bit more in the context of China's consolidated balance sheet, if you will. So the country has large debt domestically, well known, and to your point, there are ways to address it. Nothing simple, but can be addressed with some degree of brave policymaking. But we talk separately, but we don't combine it with the other issue, which is that China is a very large creditor internationally. So net, does it all work out to China's favor?
Yeah, that's another great question. I would say net, it's very difficult to really think about anybody's favor. The fact that there are large foreign assets, I think, is very important in the sense that, as you very well know from the story of what drives financial instability and what drives financial crisis, there is almost always a big link between international pressure on the currency and assets and domestic financial instability. And so China is actually similar to Japan in this sense that investors might be looking at a huge stock of liabilities, but they also are looking at a huge stock of future foreign exchange to match those liabilities. And that makes it much more difficult for a run on the currency to become a trigger for massive financial instability. And this is true both in terms of the stock, therefore, the assets themselves, and also the flow. China continues to be a net saver with a significant current account surplus in absolute terms, even if it's not as big as it used to be relative to GDP. So I would say that this external creditor status of China is something that is definitely significant and important, doesn't get us all the way out of the woods, but it does signify much more stable likely dynamics than if it were the case that China did not have this.
Right. So now the country is a major creditor nation, has large stocks of reserves, and I've been reading certain threads on Twitter lately about how there could be almost equal amount of sort of missing reserves or unreported reserves on the balance sheet of multilateral agencies run by the Chinese authorities. But at the same time, we do have quite a few large Chinese corporations who have issued substantial amount of foreign currency debt in recent years and decades, and they have a huge wall of financing coming up. And this is happening at a time when international interest rates have gone up a lot, dollar liquidity, although not as tight as we would have feared a year ago because of QT and higher interest rates, but still not as ample as they used to be, and going forward would get tighter. So US monetary policy tightening, it will have an impact on Chinese companies who want to refinance their debt?
Absolutely. And, what I would say is that the offshore corporate or the dollar corporate market for Chinese companies is very, very distorted. And so it definitely affects the overall macro. It definitely affects these companies in a negative way. But again, I wouldn't really be quick to say that this will be a source of massive overall macro instability. A few things are worth noting about that offshore dollar-denominated corporate market. The first one is that it is almost entirely dominated by real estate firms. And that is peculiar if we think about it, because real estate firms are not natural borrowers in international markets because they don't have revenue in US dollars. So this actually adds to the concerns that you mentioned. In particular, if we think about the fact that renminbi is now depreciating as well as having higher U.S. interest rates. So why are these real estate developers out there in the dollar corporate market? Well, the reason has to do with some of the repression issues that you mentioned earlier. The Chinese government, as part of its policy, has been trying to move away from what it sees as a dependence on real estate development for its economic growth, and therefore has made it very difficult historically for these firms to borrow in the onshore market. And their solution to that problem has, in many cases, been to go abroad. So there is that issue there. And then finally, I think to complete the picture, we need an idea of whether this problem, which is a real problem, I agree, is big enough to make us concerned about systemic instability. And there, I would say the answer is that it is unlikely, because even though it is big by global standards, because China is huge, it's the second biggest economy in the world in nominal terms, it is very, very small relative to the stock of liabilities or the stock of interest payments in the overall system. And again, it is also very much segmented. There are capital controls, and that this point that you mentioned earlier about China being a net creditor and a net saver is also important when we think about these factors. So I wouldn't be too concerned.
Right. This is not a dollar deficient economy by any stretch of imagination. Bit of a jump, not necessarily related to what we've been talking about, but this is something that you and I had spoken about in the past, and I really want you to weigh in. We talk a lot about China sort of running out of engines of growth, but we also recognize that there's one area of structural shift where China has massive scope for investment and growth and innovation, and they're at it already, which is climate change. So give me a little sense of your assessment on what is China doing with respect to climate change.
That is a great question. And I think that China is very much misunderstood for good reason. It's very difficult to understand China in terms of climate change. On the one hand, if you look at a snapshot of China, what you see is by far the world's biggest emitter of carbon, emitting almost as much more than at the US and Europe put together. And you see a country where emissions have not yet peaked, whereas in most of the developed world, they have already peaked. And so there is room to ask for more from China if you look at that snapshot. But if you look underneath the surface again, or if you look at the other side, China is also the world's biggest investor in renewable technologies and in renewable capacity. Again, more than the US and Europe put together. And if you look at what China is doing in terms of the energy transition in general, I would say that China is positioning itself and has already positioned itself as what I call the Saudi Arabia of renewables. China, if you look at different renewable technology segments, accounts for anywhere between more than half to sometimes 95% of the production or the capacity. 95% would be for things like polysilicon. And this puts China in a really important position as the world itself engages in the energy transition. I think the energy transition is the single biggest macroeconomic structural change that is happening in the next few decades. And China is there to be a near monopoly or a provider of a lot of those technologies. Now, of course, this does not mix well with the geopolitical tension and friction that we're seeing across the world. But China is definitely a very important player in climate and global decarbonization and will remain so for a very long time.
Yeah, I think, some of our mutual acquaintances who have worked in Hong Kong financial sector and have gone on to the government of China, I mean, they sort of tell us that in terms of driver of growth, whether it is investment or innovation in the private sector, and this is one area the authorities have absolutely no qualms about holding them back. They're sort of unleashing all the talent that they can. And it is very, very encouraging. Santiago, finally, a question on the role of Chinese capital. Every time I travel around the world, meet clients, counterparts, it's all about China plus one corporate strategy and who's strategizing in reducing their presence in China and building in ASEAN. And I think that's an interesting narrative, and there's a lot to talk about it. But a lot of the times, what is absent in that conversation is what are the Chinese companies doing in the middle of all these shifts? So talk to me a little bit about the role of Chinese capital. I mean, are the Chinese companies just sitting around and watching the whole world reshape, or they're actually part of this reshaping that is going on?
Yeah, another great question. And I think that this is also very much underappreciated. I think it's a huge development, and the reality of what the Chinese companies are doing is much more complex than is commonly described. The common narrative is that China has become expensive and firms are choosing to manufacture elsewhere, and that the geopolitical tension is driving investment away from China. And both of those factors have a grain of truth, of course, but the dynamics are much, much more complicated. A little fact to set the landscape here. A few years ago, a huge proportion of China's outward foreign direct investment was directed towards securing natural resources. It was basically in mining. Chinese companies were going out there to find oil resources, coal resources, lots of other resources. And some of that is still going on, of course, including with critical minerals for the energy transition. But the largest area of Chinese outward FDI now is in manufacturing. Chinese companies have reached the point in their global development where they're taking the outsourcing steps that developed world companies took a few decades ago. Importantly here, and probably under-recognized in many parts of the world, is that the global appeal of Chinese electronics, certain kinds of industrial goods, and especially, as I mentioned earlier, the energy transition technologies is huge. Last year, China became the second largest exporter of automobiles in the world. It overtook Germany. This year, it is set to overtake Japan and become number one. Now, just like in the developed companies and the developed world, Chinese companies are starting to follow their new customers and build facilities that cater to local markets. So you see all of these Chinese companies producing vehicles, industrial goods, energy transition technologies, set up shop, not only in Southeast Asia, but also in parts of Europe, in the Americas, And even despite the geopolitical headwinds, lots of Chinese companies are trying marginal amounts successfully to actually invest in the United States itself. And so China is an active participant in the global reshuffling of supply chains. In the regionalization of supply chains is also very important here. I think that much more than decoupling, we should talk about regionalization and the world shifting to different blocks. And of course, the Asian bloc, of which China is the central participant, is already and likely to increase in importance as the most important part of the world's supply chains. So maybe I'll leave it there. I think that these developments are very, very important. They will determine what the global production landscape looks like in the future. And it's important to understand that China is not a bystander there. They are an active participant in this process.
Santiago, the common refrain in this conversation that you and I have just had is the sort of the urge for people to sort of appreciate the complexities of a country that is as large as China. I think brushing it with one broad stroke is a mistake, but it's also a dangerous mistake. So I hope that the listeners who are fortunate enough to hear your wisdom today would at least take that key insight away. I thank you so much for your time and insight. This has been a fascinating conversation.
Thank you, Timer. Thank you for having me.
It's been great to have you. Thanks to our listeners. Kopi Time is for information only, and it does not represent any trade recommendations. All 104 episodes of the podcast are available on YouTube and on all major podcast platforms, including Apple, Google, and Spotify. As for our research publication, webinars, and live streams, you can find them all by Googling Devious Research Library. Have a great day.